these things back from our home or after coming to this country, right? So today, our team is going to dive into each registered accounts in detail and teach us how these accounts would benefit us, how these accounts work, so that we can make a better financial decision for ourselves.
You want to join this?
Next slide, please. So let me introduce our team, Toronto Financial Academy. So we are a team of financial professionals who work towards the vision of financially educating every single person in Canada. So our mission is to help educate 30 million families by 2030. So we have basically over 50 licensed professionals working in our team to achieve this mission. And we have offices in Mississauga, Scarborough, and Cambridge. Now, it's time for me to invite our first speaker, Mr. Ranjit Xavier. So he has been part of this campaign since 2018, and over the course of time, he has been able to help over 300 families in the financial planning. That's amazing, right? So without further ado, let's hear from our experienced professional what he has to say. So over to you, Ranjit.
Thank you, Archana. Thank you so much for the awesome introduction. And I was seeing that picture. I still remember our last super trip with our team and with our family. Thank you once again for sharing that photo. Once again, good evening, all. Welcome one and everyone to our wonderful financial literacy evening. So we are talking about a lot of interesting things today. So my name is Ranjit Xavier. Basically, I'm a radiology technologist. I was a radiology technologist in 2018, but I'm a proud financial literacy campaigner in Canada and United States now. So what we do, we educate families about their basic finance and what to do when a financial milestone come into their life, how to take an informed decision. That's what we do. Why it is important? I'll let you know. Next slide. So if you look around, if you look into ourselves, what's happening? These wordings, budgeting, I know it's good, but I'm not doing it. Have I have any goals? When I'm going to buy my first home, I don't know. Emergency fund, I heard it from the bank, but I don't know what to do or how to do it. And most of the people living paycheck to paycheck. Why? Because they don't know. They don't know how to budget. They don't know what to plan, but they know that all these concepts, all these financial terms are going to be useful in their life, but they're scared to do it. Of some of the reason. What happened eventually, they will increase their debt. They are accumulating more and more credit card. And what will happen? Somebody else is getting benefit out of us. Why? Because people want to meet their needs. They may doing two jobs. So who will getting more benefit? Government. Or they are borrowing money from the bank or the credit card companies. Who is getting benefit? Them, not us or our family. So bad habits and poor decisions can add up. But we can see around, there are people living in a good way in our neighborhood and in this country. What they are doing different from us? They are planning, right? Let's see. Next slide. So, this is a good news. We are going to live longer in this country. But when we live longer, a lot of other responsibilities are coming up, right? Maybe we have to plan for our retirement. We all know that our expense will not go down. It always goes up. We need to take care of our transportation. We need to take care of our mobility when we are, getting older. Nobody thinks that, we have to get the same kind of income after retirement. If you plan well, you can do that. Are you too busy during the first half of your life to prepare for your second half? We all know that we are going to live longer. Thanks for healthcare, but we have to prepare for our retirement. We have to prepare for our, long living in this country. Next slide. So we know that we have to plan, but we look into our current situation. We can see a lot of question marks. Protection. How do I do that? What am I going to protect? Of course, you have to protect your health. Then only you can make good income in this country. What if something happened to your health? Do you think you can go for work? If you're not working, what will happen? Your income is stopped, but still you have to pay for your mortgage. Still you have to pay for your car. Am I right? All of the responsibility is still there, but your income is stopped. So that is why the foundation of our financial house is protection. So you have to start from there. Have you protected enough for your responsibilities or for your loved ones? That is the first question you have to answer. You need at least 10 times of your income to be added to your protection. So there is a way to do it. If you have any debt, you have to manage your debt. Then you have to build an emergency fund. How do you do that? At least you need to have a 6+ months of your expenses should be, you have to be in your emergency fund. Ask your question. And then comes the investment, most exciting part. Everyone is interested to invest, but the question is, do you do it in a proper way? This is a building a proper financial house. When you do that, without strong foundation, your financial house won't stand. Next slide. So how do we do that? When we look into our current scenario, assume that this is your life. Now you look into your own life. We have a lot of responsibility, right? Maybe your home, your back home responsibilities, your kids, your parents, you name it. Many, many responsibilities. You have to take care of your responsibilities. Meanwhile, you have to build your wealth. How do we do that? So when you protecting your responsibilities, you have to adopt dime method. As I mentioned, you have to protect your debt, you have to protect your income and mortgage and your education for your loved ones. That means your kids. And meanwhile, you have to take care of yourself too, right? So you have to build your wealth. How do you do that? You have to save money. You have to give time for your money. For what? Your money should grow. How do we do that? You have to put in a place you should get at least a good rate of return. All of you can relate. If you put your money in your bank, maybe you get 1%. If you are lucky, if it is not 1%, what is going to happen? We will see today. And it should, whatever money you save, it should not affect your inflation and your tax. Then only you can grow your money. This slide is a simple example. Sarah's go ahead. A simple example, if you're putting your money in a bank or money in an investment institution, what is the difference? Investment institution, what are we going to get? Rate of return. So look into that, Saras. So most of you, maybe some of you are students, some of you are landed immigrants, some of you are already many years in Canada. You all know that banks are giving very less interest for our money. But if you choose investment institution, assume that you are getting 6% of rate of return. This is a wonderful formula, which is called by rule of 72. 72 divided by whatever interest rate you are getting, you can get how many years your money become double. So if you are getting 6% rate of return, 72 divided by 6. Every 12 years, your money is going to be double. If 8% rate of return, every 9 years. It is 10% rate of return every 7.2 years. So if you are lucky enough to save $10,000 in a place, you are getting 10% rate of return. In the 36th year, you will be having a good amount of saving, which is $300,000. If you are saving in a proper place, you can save a lot of tax. So that is what you are going to see in our next speakers. They will guide you how to do that. Meanwhile, if you are keeping the same money in the banks or the place, you are not getting a growth. I'm not talking about 1%. Let's assume you are getting 5% rate of return. What is happening? Assume that you invested $100, you are getting 5% rate of return. But if you are keeping in checking your savings account, you have to pay tax. Assume that you lower tax bracket 25%, $1.25 gone from your return. Net 103.75. What is happening? We have to add inflation to it, right? If we add average inflation, let's assume it's average, 3%, the $3 is gone from your grown money. So actual rate of return is $100.75. My God. So that's what happening if you're getting 5% rate of return. You have to plan. Assume your income is $60,000 and you are getting 10% rate of return, and you can save. You are blessed enough to save husband and wife saving a $500. That is $17 per day. Think like this. Very first hour's salary or half of your salary, if you can save in a place you are getting 8% rate of return, your money will be close to, any guess? It's Cyrus. More than $500,000. If it is 10%, it is more than $1 million saving in your own account. How do we do that? With discipline and budgeting, you can do it. So you need a plan for that. How do we do that? When you save that hard-earned money in a place, you have to make sure that these four elements you are getting. One, growth. You should get growth. You saw that 5% growth, it is not enough. At least 7 to 10% growth. So you cannot put your money in not in a place you can get safety. Safety is most important. You have to trustable place. People will think that banks are good, but banks doesn't have growth. Why banks are safe? Because of CDIC. Similarly, when you invest, make sure that whether it's an insurance company, whether it's an investment company, make sure that it's government regulated, means it is regulated by FHSA. So you have to make sure that. So what is the third element? It should be tax advantage. We know that checking and saving is not tax advantage. So make sure that it should be tax advantage place. Last one, and the most important one, protection, because you have to protect your health. You have to protect your income. Otherwise, we cannot do anything else. So make sure that these four elements will be there in your investment. So you have to plan with the help of a licensed professional. So they will be helping you. So you can do it yourself if you are a knowledgeable person. When saving and investing, consider these four elements we just saw. Okay. So I just want to show you an interesting thing. People will think, where do I get that 7 to 10%? Where do I get that more than 10%? I never heard about it. There are many portfolios in investment side regulated by government companies. You can invest your money in a place. You can get average 15 to 17%. You can talk about this hours and hours, but look at this. This is a diversified portfolio called a global equity. It's listed in US stock exchange, but not in one company, in many companies. You can see Apple, that is familiar, right? You can see Nvidia, you can see Amazon, Microsoft. We're not buying a specific company. We can buy a group of companies, and basis of their performance, your money will grow. Look at the growth, 17%. If you have a person who have money of $10,000 in 2014, if you invested, by this time, it is $48,000. And it's not risk level, if you consider, that's a moderate risk. Next slide. Similarly, it's almost close to the previous portfolio, but you see that it's a little bit higher risk, not low to moderate, it's a moderate. Still, it's lower risk. Average growth is 12%. Next slide. This is a NASDAQ portfolio, a little bit higher level. If you have time, if you are young enough to invest and you can invest another 20 to 30 years, you may be blessed to get 17.35 rate of return on your hard-earned money. If your person invested $10,000, you will be getting $48,000 in 10 years. All these concepts, if you can do, if you know how to do, when to do, and what to do. That is what we are teaching in Toronto Financial Academy. You can listen from my other teammates and colleagues. They will give you a clear idea of what exactly we have to do in your own investments. So this is just an example. If you have any further questions, don't hesitate to call the person who invited you to this webinar, and we will be happy to answer any of your questions. And you can join us always, any of our offices. We already shared our office addresses, and contact the person who invited you. Okay. Thank you so much for your time. I would like to invite a special person, none other than Tony. You can see that in the NASDAQ. The first one is Apple. He's an employee of Apple. He's working in Apple. And he came to this beautiful country in 2022 as an international student. His name is Tony Sabu. After his studies, by the God's grace, he got placed in Apple, and he's working in Apple maybe an IT professional, a software engineer, why he's worrying about finance, we can hear from him. So over to you, Tony. Thank you so much. God bless you all.
Thank you, Mr. Ranjit, for that amazing introduction. So as he introduced, my name is Tony. I came to this country as an international student back in 2022. My background is in software. I'm a software engineer. Currently, I'm working with Apple. And I joined this amazing campaign, the financial literacy campaign back in 2023. And I got the license from the FSRAO, and I'm working as a licensed financial professional for almost 1.5 years, along with the job that I'm doing. So today I'm going to discuss a little bit about a tax-free savings account. Most of you might have know what a tax-free savings account is. At least you might have heard about TFSA. So that's what a tax-free savings account. So the idea is very simple. It's just like your normal savings account, but in a normal savings account, whatever interest that you make through that, you have to pay tax on that. So that's why government introduced this registered account called tax-free savings account, where whatever interest or whatever growth that you make on that account, you don't have to pay any tax on that. That's the main advantage of a tax-free savings account. So obviously, there will be an annual limit set by the government, and this year's limit, 2024's limit, is $7,000. That this is a cumulative thing. So the TFSA account was initially introduced back in 2009, and from that day onwards, it is cumulative. So a person who landed in Canada, just like me, who landed in Canada in 2022, how this works is like, I have the room which will be open up from that particular year when I landed in Canada. And up to now, from 2009 to 2024, the total room is $95,000. And there are some rules for you to open a TFSA account. First one is that you need to be at least 18, or you need to be 18 when you entered into Canada. And from that particular year onwards, even if you don't have that account, even if you don't open that account, the room will be accumulated there. So coming back to my example, I came to Canada in 2022. I haven't opened my account, let's say, in 2022, and I decided to open the account in 2024. So when you calculate, I have the room from 2022, 2023, and 2024, which will be closer to around $20,000, and I can put the money, that much amount, into that. And whatever interest that I'm going to make over there, I don't have to pay any tax. That's the main advantage of a tax-free savings account. The main use or the benefit of a tax-free savings account is that you can use this account, or the money from the TFSA account, you can use it as an emergency fund. There are so many emergencies that can pop up in your day-to-day life, right? Winter is here already, so we need to change our tires, all these things. And if something happens to our car, if a tire blows out, we need to repair that. And there are so many emergencies can come up. And this money from a TFSA account, you can withdraw it at any time without paying any tax. So you can use it as an emergency fund. And the withdrawals result in calendar year grace period. That means if you withdraw the money from a TFSA account, you won't be able to put it back in the same year. You had to wait for December 31st of the same year in order to replenish that particular room that you have withdrawn. And if you put extra money, if you put more than the limit that the government is set, then you have to pay 1% penalty on that. So let's consider some frequently asked questions in terms of TFSA account. So I came to Canada 7 years ago at the age of 30. How much room do I have? So as I mentioned, the room will start from the year that you entered into Canada. So if you came 7 years ago, that means your room will be at $43,000. That means from the 7th year to the current year. Yeah. Next one, please. Can I withdraw money from the TFSA and put it back later? Yes. You can withdraw the money, but you cannot put it back in the same calendar year. You just have to wait for the next year to start, and then you can put the money back. Yeah. So the third one, can I have multiple TFSA accounts with different institutions? Yes, you can have multiple TFSA accounts. Only thing is that all combined together, the TFSA accounts, the amount should be within that limit of that particular year, or within that limit of the cumulative limit. So you can have multiple TFSA accounts. Okay, so let's meet one of my good friend Aaron. He's at the age of 28. If he do the contribution of the entire amount, and let's say that he arrived in Canada in 2019 when he was at 23A, and his entire TFSA limit would be $37,500 if you add from the year of 2019 until 2024. His room will be $37,500. And let's say that Aaron invested all the amount, all the room, and if he is getting at least 8% of an interest of compounding interest within the 6 years, his $37,500 will be growing up to $72,300. And if he is putting that at TFSA account in an investment where he is getting at least 10% growth, then his amount will be growing up to $85,000. And if the same person is putting the money in an account where he's receiving 12% of interest, then his total TFSA room will be growing up to $100,000. So as I mentioned earlier, TFSA can be an account which can be used as an emergency fund. And if you use it wisely, if you put that money in an account where you are receiving at least 10 to 12% of interest, you can make a beautiful investment from that without paying any tax. That's a main advantage. And you can withdraw this amount at any time without any restrictions on that. That's the way how you can utilize your TFSA. All right, so now it's time for a small testimony. Let me introduce Mr. Talbin Thomas. He's a facilities engineer. He came to Canada last year, 2023. He was working as a facilities engineer in UAE. So without further ado, Talbin, take over.
Thank you, Tony. Thanks for the wonderful intro, and your presentation was nice. You know how to get some extra percentage on your investment. Good evening, all. I'm Telvin Thomas. I'm a financial literacy campaigner with Toronto Financial Academy. My previous experience, as Tony said, as a facility engineer, and I worked almost 8 years in UAE. Since I came to Canada, all the financial concepts are different. Most important realization was tax. You know, when we make money, they will tax us. When we spend money, there will be also taxes. When we save money, they will tax us. When we die, of course, they will tax you. Many people have heard about the RRSP, TFSA, FHSA, but they don't know how it's going to be benefit for them, how to utilize for the wisely these accounts. Many of them heard about the registered accounts and opened this type of accounts and don't know how to invest and get some reasonable income for their future. As Tony said, 8% or 10% or 12%, or else at least a 5%. I know someone who has been here in Canada almost 14 years, well settled people. I had a conversation with them regarding the RRSP and tax savings, and they said it's not required. Surprisingly, you know, it's surprising to hear that it's not required from a 14 years experience or living person who has been here, and they would dismiss the importance of RRSP. While it's true that not everyone can afford a significant amount or monthly contribution for RRSP every month, even small amount can add up over the time, especially when considering the tax benefits. You know why this misconception is happening? There could be a few reasons for the misconceptions. Lack of financial literacy. Some individuals may not fully understand what is the long-term benefits or how the interest is going to be helped them. Attend workshop, they will be going to be get more knowledgeable. Short-term financial pressure. The credit card or car loans. Sometimes it's happens. So that time we can skip that one and we can pay. And misinformation and misunderstandings is an important point that's going to be affect the people. maybe they are not going to ask a professional. They are going to ask their friends. Oh, what is RRSP? Oh, it is for only for the money that going to be deducted from the account. So if you are going to get a professional advice, of course, it will be helping. That's why I joined the financial literacy campaign and started learning and applying this knowledge in my life, and it's helped me a lot in many ways. So finally, I would like to introduce the next speaker, who is an uh, experienced financial campaigner, Mr. Cyrus, an army man who turned his profession to the financial industry recently. Over to you, Cyrus.
Awesome. Thank you very much, Mr. Talvin. Good evening, everyone. It is an absolute privilege and an honor to be, sharing this information with everyone. And yes, my name is Cyrus Jason, and I've been a very proud financial literacy campaigner for actually the last 4 years. But I came from a background of working in the Canadian Army for the last 6 years. And honestly, one thing I learned is we can work so hard, right, in any industry, in any career. But at the end of the day, the more we work, the more income we make, the more taxes we have to pay. So tonight, the main goal behind this information session to really push all the different opportunities we have here that are actually made by the government. These are all registered accounts, and all registered accounts mean is that we have to have a social insurance number. They are registered with the government, so they know where the money is at, and we have a few benefits that come along with that. Right. So for me, as Mr. Talbin mentioned, yes, I did come out of the Army or released from the Army this past year, and decided to go full time in this financial literacy campaign to spread the education, absolutely, but to help to reach our goal of educating 30 million families by 2030. So for tonight, I want to talk to you about the second registered account, right? So you heard from Mr. Tony already about the TFSA, or the tax-free savings account. But now I want to talk about an account that's actually meant for first home buyers, right? It's called the FHSA, or for the first home savings account. The first home savings account was actually released, it was available to the general public in 2023. So that is very recent, compared to the other different registered accounts. And it's, basically meant to help Canadians who are struggling to purchase their first home. With the increasing markets, right, the prices of houses going up, the government came out with this account for us to actually utilize. So we can put in up to $8,000 a year into this FHSA for it to actually grow and for you to utilize for your down payment on your first home. And you can do this, the same $8,000 for 5 years. So in total, you will have a $40,000 limit for that FHSA. And as I was mentioning, the $40,000 plus, as you heard from Mr. Ranjit, the different funds, the different portfolios that we can actually put all of these different accounts. We can actually put our money into these different portfolios, so we actually are gaining that growth, right? And with that growth within the FHSA, it is actually tax-free, provided you are using it for your first home purchase. Right now, other withdrawals will result in taxes that you will have to pay on the growth. However, as long as you use it for that first home, there will be no taxes with the FHSA. Now, the first home savings account is actually ideal for those who are planning to buy a home less than 15 years. Okay, the reason being is that the FHSA actually has to be closed within 15 years of you opening the account, or before you turn the age of 71. So it is whichever one comes first. But essentially, most people that I talk to, and most people that I think we are on that general scale of, we start making a real plan to buy a house. We hope we have a goal of maybe 10 years, but we really start making it work within that 5-year period, right? So if that's the case, just know that you do have the additional, 15 years for you to actually make that purchase, and for you to utilize the growth within the FHSA to actually help you get to your down payment goal. Now, ladies and gentlemen, it's not just the $40,000 plus the growth that you can actually earn tax-free from the FHSA, but all the contributions that you make within the FHSA actually brings you tax deductions. If you ask me how, I'll tell you that, the tax that we pay or we already paid on the income that we earned, right? If we take that income and we put it into the FHSA, the tax that we already paid, we will get returned back to us when we go file our income taxes. And I'll actually show you a scenario of how much actually we can expect to get in return when we do go file our taxes, so that we understand how the contribution for the FHSA works. Now, some of you may ask me, Cyrus, what if I don't, buy that first home? Well, absolutely, you can transfer your FHSA to your RRSP in the event that you don't purchase that first home. Now, I won't talk too much about the RRSP because we have a fantastic trainer coming up who will give you more details on the RRSP, so that way we can learn more about that as well. Now, again, similar to our tax-free savings account, we also have a over-contribution penalty of 1% every month. Right. So every month that you have that over contribution, there will be a 1% penalty we have to pay. So when you have, a financial literacy campaigner there to assist you, we always to make sure that we take a look at the overall contributions so that we don't have that over contribution penalty. Now, if I asked you, right, and I want to actually allow anyone to unmute and give me a guess here or what you think if you already know, but there is a contribution deadline for our first home savings account, right? The reason why we are having this information session tonight is because the deadline is coming up very soon. What this deadline means is that you can, for this year's income, in order for you to have tax deductions, the amount of money that you contribute to your FHSA before this deadline is what will actually be deducted from your income. So if I have any guessers, I will, you can definitely unmute, go ahead. I'll give you three chances. Three going once, twice. Okay, well, you know what? That's why we're all here at the information session tonight, right? So it's 11:59 p.m., December 31st of this year. So it's actually coming up in just over a month, but make sure that we have all of our contributions done. They're all, handled well. The applications are submitted. So that way that contribution will count towards this year's income tax deduction. So, few frequently asked questions here that we commonly get that I just wanted to address, right? So I just bought my first home. Can I still utilize the FHSA, right? So it is the first home savings account, right? So it's meant for that first home buyer. But here's the truth. Yes, you actually have up to 30 days after closing on your home to utilize the FHSA. So whether it be for the tax deductions or for you to actually have that tax-free growth, you can utilize the FHSA up to 30 days after closing. Now, second one, can I withdraw money from my FHSA and put it back later? Well, I did mention this. If we do use it for any other reason other than our first home, there will be taxes payable on the growth that we actually earned. And now, can I have two FHSA accounts for my spouse and I, right? Can my spouse have one and can I have one? Well, here's the truth. Yes, you can purchase your first home, or when purchasing your first home, both spouses can utilize the $40,000 each. So $80,000 altogether, they can actually utilize individually, right? So 40,000 each, together 80,000 for them to actually be prepared for that down payment. So, similar to Mr. Tony, I want to introduce you to one of my friends, Miss Alexia here, who is on the way to actually purchasing her first home. So at age 25, Alexia's pre-tax income, is $52,000, or in other words, $25 an hour. So someone at this bracket, right, at this age, how can they actually purchase their first home within 5 years? Well, here's the thing. Here's the reality, right? With that $52,000 income in Ontario for 2024, we actually have to pay over $10,000 in taxes. But as I was mentioning with the FHSA and the next registered account that you will be hearing about, we can actually contribute the $8,000 and in this case, based on her income, $9,000 into her RRSP. So, ladies and gentlemen, if she contributes 50%, right, of her total limit, because some of you may tell me that it's okay, you know, I that 8,000 is a big number, Cyrus, and you're right. But just look at the simple math here. If we only do 50% of the contribution, you actually will get back $1,893 in that income tax return. Now, if you can put a little bit more, push yourself a little bit more and put 75% contribution, now your tax return is going to have $2,764, right? This is, I'm not saying that this is a guaranteed amount that will be given back to you depending on your other taxes, right, going on, but purely from the contribution you make into the FHSA and RRSP, this is what you will be getting back. And then, of course, at 100%, you actually stand the chance to earn $3,784 back in taxes from, or in that tax return. So that way, Mr. Trudeau doesn't keep all of our hard work, right? I know I personally worked for the federal government, and technically he was my boss's 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 boss. But at the same point, right, we want to make sure that that hard work actually stays for us and our family. So now, because Alexia, right, is on the verge of buying that home, she takes her tax returns and actually invests it back into her TFSA for these 5 years. Why? Because she really wants to buy that first home. So let's take a look at what happens. Now, Alexia is 30 years old, and Alexia has saved for her down payment. How did she do that? Well, she contributed the full $40,000 in her FHSA over the 5 years period. And now over those 5 years at a simple 10%, which again, Mr. Ranjit talked about the different portfolios that can have access to, you know, these kind of numbers, but that actually becomes over 5 years, $64,000. Now, with her TFSA, only putting in her tax deductions, right? The return that she got from her tax deductions, she put in $18,000. And over at 10% over 5 years, similarly, it goes up to $30,000. So just here alone, right, she has just under $95,000 of pure assets that she can utilize to actually purchase that first home. Well, now, ladies and gentlemen, with your RRSP, you actually have a first home buyer's plan as well. So you can borrow up to $60,000, which will be payable over 30 years. But ladies and gentlemen, if you combine all of this together in that 5-year period, Alexia had saved $154,000 to buy her first home. And now if she doesn't use her home buyer's plan, no problem. That $60,000 is not there, but she still had $94,000 there available to her to purchase her first home. So, ladies and gentlemen, I want to thank you for you know, giving me your attention and really learning to utilize the FHSA, which is one of the registered accounts that you will be hearing tonight. And without further ado, I want to introduce our you know, next testimonial speaker, who actually comes from the medical background as well, and a registered nurse. So we know really how hardworking and dedicated of individuals they are, right? But she is also a mother of 2 wonderful boys, right? And she is a very, very knowledgeable financial literacy campaigner who we can all learn from. So I want to hear how you know, Miss Ninu George came from the registered nurse background and really was able to take this financial literacy campaign forward. So Miss Ninu, go ahead.
Thank you, Cyrus. Thank you for that wonderful introduction. Good evening, everyone. My name is Ninu George, and I have been in this financial literacy campaign for the last 3 years. I'm a registered nurse by profession. You may be wondering why a registered nurse in this financial industry, right? Well, my friends, during my medical career, I have heard a lot of people, you know, talk about, you know, they are struggling about their mental health because of too many medical bills, uncertain about their retirement. So, you know, it is very, very, very important to have a healthy financial well-being, right? Being a medical professional in Canada, I have often heard my colleagues or my friends talk about too much taxes, or we have to pay a lot of tax, from our hard-earned income. But I never heard anybody talk about how we can save those taxes, right? So the reason is not too many people, like, Telvin was mentioning, not too many people have these type of knowledge to save money, or how we can save the tax. After joining this campaign, I understood the importance of, having a strong financial understanding in our life, in terms of, our kids' education, our savings and everything, right? So being in this campaign not only give me a good financial career, but also it gave me a deeper understanding about the importance of having financial independence. After attaining all this knowledge, from this beautiful campaign, I've attained a lot of knowledge. Right now I'm very, very confident about, dealing with my personal finance, and also the people I'm helping with. And I'm very, very proud of being a part of this wonderful campaign. And thank you everyone. That's from my side. And today, our next speaker is Mr. Aaron Anthony. He's also a registered nurse, and he has been in this campaign full time for many years. He is well knowledgeable about the topic he is going to talk about today. So please have your undivided attention. And without much delay, let me welcome Mr. Aaron Anthony. Thank you.
Thank you, Neenu, for the introduction and your amazing testimonial. So, good evening, everyone. As Neenu said, I am also a registered nurse. You might be wondering why I am in this campaign, right? Well, all the technical terms, I was stunned at those technical terms, and I was unable to make decisions when it comes to my taxes and my family's future. So I thought, why not give it a try so that at least I can help myself, right? And that's where I learned so many things. Now I understand that many of my friends are having a difficulty understanding those things. So I took it into my hands, and now we as a team, we are going forward. So without much delay, let me start. The main agenda tonight is discussing how to save taxes. But just before we go into the next tax saving account, I just want to go over quickly to this registered education savings plan, which gives a lot of grants for our children. So I know we have 79 people, 80 people here. So definitely some of the kids are there, they're growing, and they are going to go to university in the next 15, 20 years. So the government of Canada has an amazing program for them to go to colleges with less debt, right? So the main attraction of this account is two different type of grants. So if you open one of these account for your children, they can have two different type of grants for them. One is Canada Learning Bond, which is a $500 one time. Even if you do not put money into that account, the government puts $500 for it. And after that, every year, the government is willing to put $100 up to $2,000 all through the years. So that's the advantage of this Canada Learning Bond. And if you talk about Canadian Education Savings Grant, which is if you decide to put some money into that account, the government is ready to put 20 to 40% of your contribution. For example, if you have a plan to put $100 for your child, the government is ready to put $20 to $40. It is based on your income in the previous year. So it can vary, but a minimum of $20 up to 40%, right? So there are more technical things into it. I just want to go over it. So you can accumulate that money and grow. You can invest, and you can use that money for your child's education anywhere in the world. That's the advantage. Anywhere in the world, not only in Canada. If you study somewhere else, still we can use that. So let's get into our hot topic tonight. It's another tax saving account, which is registered retirement savings plan. As the name says, this is primarily for retirement, but it comes with a lot of tax advantages. What are the advantages, right? Just like a FHSA or TFSA, this also has a contribution limit, which is the 18% of your previous year income. So if you haven't worked in the previous year, you cannot open an RRSP account this year. But if you are a person who worked in the previous year and you have some income, then you file your taxes, definitely you can open an RRSP account this year and you can contribute towards it. So the advantage is anytime when you put the money into this account, and that much of amount will be reduced from your last year's income. And if you have paid any taxes, when we make the money, the government take the taxes. So that tax will be refunded to you based on your current bracket. The growth, you can choose investments. That's the advantage, right? You put the money in there, you can now choose some investments so that money can grow. And anytime if the money is growing and earning interest on it, then that money is called tax deferred. The earnings are tax deferred, which means you do not pay the taxes on that growth while it is growing. You only pay it when you take it out. Early withdrawals result in taxes. That means sometimes you may have this question, can I put the money now and maybe after 5 years, if I need some money, can I take it out? Well, that it happens if you take it out, that much of money will be added to your income on that year. So if you have other income, like if you're already working and making money, and this money also will be added into that income and you will end up paying more taxes. So it's not advisable to take the money early, right? But you have another option. You can take up to $60,000 towards buying your first home, just like a FHSA. And on top of the FHSA, if you have an FHSA and an RRSP, you can take the advantage of both. You can use both. And if husband and wife, both of them have 2 accounts each, they can take the advantage of 4 different accounts, right? So up to $60,000 can be withdrawn from your RRSP account without paying any tax if you are using it for your first home, which means, let's say you took 5 years to accumulate that $60,000. All these 5 years, you enjoyed the tax break. Now you are taking all your money out to buy the house and you don't pay any tax, which is great, right? You have to, at the age of 71, you have to transfer this money. If there is money in the RRSP account, you have to transfer that to RRIF, which is called income fund. You should take it as an income and you should pay taxes on that. The idea is when you are earning a lot of income, when your income is high, you need to put the money in and you take the tax break. But when you are retired or in later 70s, your income is low or you don't have any income, then you can take the money out without paying very less tax or without paying at all. So it depends upon your situation. If you ever over contribute, you pay 1% penalty. So probably you may be wondering, am I going to do something mistake or anything? Then it's better, I would suggest you consult an advisor who can look for you whether you're over contributing or not. And just like a FHSA, RRSP also has a deadline. So does anyone want to volunteer and put in the chat? What is the date? Just 1 second, 2 seconds. Yeah, so it's February 28th. So you got 3 more months. Yeah, I see Sonia is answering. Yeah, thank you for the reply. So February 28th is the last day. So you can, open an account and deposit money until February 28th, 2025. Don't wait for the last minute, okay? Because lots of people are going to use the opportunity and advisors are busy and sometimes technical issues can happen. So you can contribute and take the tax break before that. So oftentimes we come across some frequently asked questions. One of the questions is, can I withdraw money before I retire? That's a great question. Yes, anytime you withdraw the money, you will be paying taxes. So the issue is, if you have already earning some income and in the given year that you're withdrawing the money, you probably end up, bumping your tax bracket into higher, and you pay more tax. So therefore, it is advisable to withdraw only when you have lower income or after retired, ideally retired, right? So again, talk to your advisor so that they can help you, give you some insights. Does my group RRSP also count towards my contribution limit? Yes, this is another catch. Imagine you are working somewhere and your employer also helping you open an account and putting some money into that RRSP account. What happens is that reduces your contribution limit. So you may think I have some $6,000 contribution limit, but your employer might have put some $2,000 into it. So then what happens is if you over contribute without knowing that, you end up paying 1% penalty every month. That means if you put $1,000, you pay $10 every month until you withdraw that much money. So we don't want to go into that kind of a danger, right? So it's better talk to an advisor so that they can look into it and help you, give you the right advice. Well, the last thing, what happens to my RRSP once I pass away? That's also we need to know. You can roll over to your spouse tax-free, which is, your spouse can have the same account for free. There is no taxes on that. But she will be paying taxes when she withdraw the money, right? So that's about RRSP account. So let's take a couple of scenario. My friend here, meet Shirley. Shirley is age 35. Her annual income is pre-tax $72,800, which is $35 an hour. So you might be knowing some of your friends earning around $35 per hour, right? So in Ontario, what happens is she might have paid $17 or close to $18,000 in taxes. She even though she made around $72,000, she never has seen that 18,000. So then she will have an RRSP limit of $13,000. Then if she decided to use 50% of her contribution, she might be saving some $2,000 in tax refund. If she happened to use the 75% contribution room, some $3,000, and if she uses all the contribution rooms, then some $3,800, right? So that much money can come back to her from, if you look into that, that's like a 1 month paycheck, right? So that much of money can come back. Upon retirement, what happens? She might have contributed $200,000 over 30 years. All these years she's been using that contributions. Then every year she enjoyed the tax break. Every year she took the tax refund. Then what happens is she might have accumulated really good retirement savings. At 8% rate of return, you can see here the magic. In 30 years, it is around $750,000. But at 10% interest, you can see $1.1 million. At 12%, it's $1.7 million. But if you look into the scenario between 8% and 12%, it is some $1 million difference, right? If you look into many of your friends, they are in their 60s. Their entire life saving may be close to $1 million or a little bit over that or more than that. Just because they, even if they have taken the advantage of all the deductions and all, but if they forget to take a look at the interest rate where they can hire, they are missing out on the entire life saving or more than that. That's the reason, while we are focused more and more on taking the deductions, we should look into the other aspect, like which account do I park the money? How much money is growing? Is it going to be giving me a dependable income while I'm retired? Those aspects you must consult with an experienced person so that they can advise you the best for your future and your family's future. So that's the quick side from my side. And now, when we share these kind of insights, we happen to meet one amazing personality. She decided to work with us. She is also a proud campaigner. I would like to invite Ratnavati from Montreal to hear from her testimonial, how she is benefiting from our platform. Ratnavati, you can take it over. Thank you. Have a great night.
Thank you, Arun, for inviting me. Good evening, everyone. This is Ratna. I came to Canada in 2019 with my husband and with my little daughter. I worked in Canada for 3 years. After that, I quit my job because I want to have more time with my daughter. When I was working, I need to go to the office every day and I come back. It's so busy life, right? So I didn't have, when I was doing job and all, I didn't have more time to spending with my daughter. I didn't have time to take care of my family. I did so many sacrifices for my job life. But by the end of the day, I need to pay the more taxes, more taxes. I paid a lot of taxes, regular taxes also. I paid, including that, more excess tax also I paid. So what is the reason I did so many sacrifices? I need to pay the taxes, right? So I did sacrifices, no mean it. So that's why main reason I chose this financial literacy campaign for uh, in this campaign. I would like to educate myself with financial education, and I would like to educate others as well. I'm really, really proud to be part of this financial literacy campaign, and we can save some money. We can save some money with the reducing the taxes through registered accounts like TFSA, FHSA, RRSP, RESP. We all need to know information about all of these registered accounts. Thank you for all of the speakers to the valuable information, and especially thanks to my friends who were accepted my invitation and joined in the session. Now I would like to invite Rinsi Varghese, who is mother of 3 kids and she's inspiration woman. Please welcoming her with me. Rinsi?
Okay. Yep. Thank you, Ratna. Thank you for a wonderful introduction, as she said. Anyway, good evening all. And she said, my name is Rinsi Varghese. I've been with the Financial Literacy Campaign for the last 5 years. And I have learned all these registered accounts from after I joining this campaign, even though I've been in Canada for last 20 years. Nobody taught me any of these registered accounts. I knew that some of the accounts are here in Canada, but I didn't know that what is the reason for, or like what is the user for, right? And my dear friends, let me ask you something. Our hard-earned money, right? Every day, 8 hours, 12 hours, we are working in Canada. Who is more interested in our money? Is that government? No, right? Employer? No. Is it a bank? No, this is only us, right? So what we can do is we can learn ourselves and do it properly in our personal finance. At least we can achieve our goals. So I know that it's like a little bit a long session, but whatever we are saying that like all the registered accounts, many of you have the question that like that, like where we can start, how do we do it? It's like a financial planning. We can say that it's like a building a house or building a future. While when building a house, you need to make sure all aspect of the house, the foundation, roof, electrical, plumbing, interior, it has to be in proper in place. At the same way, we have to do it our financial too. And education, we know all the TFSA, we have to do it, RRSP, FHSA, everything. But the problem is we don't know where to start. Then for that, we can help you with the best tool. We will help you with we will call it as like a financial checkup. So for the financial checkup, next slide, please. For the financial checkup, like we are familiar with our physical checkup or like a yearly checkup, something like that, right? The same thing,
The financial checkup, what we do is we are sitting with you and we will analyze your financial situation. We can say like a current situation. What is your expenses? Are we paying anywhere extra where we can save some money and put it in our future? The same way we are doing in our financial checkup as well. Once you done with your financial professional, then they will suggest to you, okay, these are the things we need to do it. They will assess you, what is your goals? Is it any goals in the less than 1 year? Okay, maybe the 1 to 5 years, maybe you will have a home, right? So what are the accounts you need to open first? Then 5+ year, what is your goal? So we can suggest you and we can inform you, right, what regarding the finance. So if you have the will, we can provide the vehicle. Financial security is not a dream, it's a priority. That's what we all believe in that. That's why you can see like you have like we have different professionals backgrounds. We are get together and join together and do the financial literacy campaign again. My dear friends, think about it. We all came to Canada for what? For a quality life or the better life and achieve our goals. The question is, if you are doing the same job what you are doing today, can you achieve that goal? And everybody knows that like, okay, we need to save our money and we know how to save our money or where to save our money. But the problem is, if you don't have money, what we can do, right? So for that, and gain knowledge is good, but apply knowledge is better. So for that, if we have more money, if anybody is looking for an extra income, and the main thing, like there is the two important things that you can take away after our seminar. The first thing is, either you can sit with a financial professional and they will help you to manage your personal finance, or you can learn and apply in your life and you can make it as a part-time income. We will more than happy to help you that. So be part of the campaign. We all are welcoming you all for be part of the campaign that is revolutionizing the financial industry with a system that bridges financial education and financial independence. So we that's all. Like we know that like many questions regarding the registered account or the part-time income or again our campaign. If you have any concerns or questions, contact your person who is invited to for this session, because they knew that this session will help you and it will help you in your future and you can take an extra step. So I would like to thank all the guests and all the teammates who has attended in our seminar. It's like a wonderful, very successful event. And Toronto Financial Academy, we are conducting like more sessions upcoming months with regarding kid saving and investing in Canada, understanding credit and budgeting for your life in Canada. So all these contents we are explaining, we are making a seminar for our following months. So stay tuned. And again, like maybe we can, we have like one survey is going on. So if before you close it, so then you can fill up the survey. That will be better. So being that said, that will be from our side, and have a good night.
Before you go, make sure that you do the survey. There is a gift card. I think Rincy just forgot to mention. So those who are doing the survey, you qualify for the gift card. Those who are out of province, don't worry. You can contact the person who invited you. They will be arranging the best way to reach you out if you want the gift card. So once again, thank you so much for joining us. Before you go, you can scan the QR code and claim your gift. There is, I think Cyrus will be posting the link. It's already posted, so you can get it from chat box. You cannot scan the QR code. You can click on the link, either that or this way, so that we will know about your opinions, what you need. If you need any education materials, all those stuff, we can send you to the email, because those who registered, we have your email. We'll be sending the material. Thank you once again. God bless you all. Have a wonderful night. Don't forget to scan the QR code. Thank you.
we want to each one of you just let your invitee know, the whoever invited you, just let them know how we did and how did it helpful, so that we can have more sessions like this about kids education strategies, then life insurances or investments, different things, estate planning. There are a number of topics, credit scores, credit cards, then loans, different type of loans, good debts and bad debts, all these kind of sessions we can discuss topic by topic. So we want to hear from you. Just give us your thoughts. Thank you so much.